Welcome back to our video series. Today, John and I will be doing the important numbers to know for 2025, which has been our most popular videos to date. So we're excited to bring you this information. We think it'll be very useful as you plan for next year. Um, every year, the IRS updates a lot of the tax brackets and contribution limits and income limits. So we love going through this to point some of these out. So, John, I'll let you get started and tell me about what's happening with income tax.
Yeah, we're going to try to be pretty concise here, try to keep the video short, but as you'll see on the screen, these are the new income tax brackets for 2025 if you're filing as an individual or married filing joint. And the thing we just want to say about this, I mean, one, they've been inflated a little bit from last year. It's important to know your marginal versus your effective tax rate. So marginal, we have progressive taxes. So as you as your income goes up, you kind of progress through these different tax. Everybody starts in the 10% bracket and then 12%, and it's only your highest income that gets taxed at the highest rate. That's what we call the marginal rate. Effective rate is essentially how much tax did you pay over your total income. That's just referred to as your effective tax rate. So it's important to understand those differences.
Also, John, on those marginal brackets, that's on your taxable income, right? So it's not total income, it's after all deductions.
Correct. I mean, this is kind of really the bottom line. What is your tax based off, which is your taxable income? So you start with your gross, you add, your work income, you'll add your investment income, maybe you pulled from a retirement account. That gets you to total income. Then there's adjustments, and then you get into standard or itemized deductions. But this is kind of the bottom line. My taxable income number is this, and that is what your income tax is based off at the end of the day. The standard deduction heading into next year, married filing joint, is 30,000. As an individual, it's half that. And then it's important to know if you're over the age of, if you're 65 or older or blind, you get an additional deduction on top of that. So again, this is just the amount the government gives you without you having to itemize on Schedule A. As you'll see, the thresholds for capital gain rates is up a little bit, and essentially this is for long-term capital gains and qualified dividends. If you are in a 10 or 12% tax bracket, you might pay 0% tax on your long-term capital gains or dividends. And then once you get over certain thresholds, those are taxed at 15%, which is still less than your ordinary income tax rate. And eventually, if your income's high enough, you'll be taxed at 20%. So it's important to keep an eye on those numbers, especially if you're thinking about, selling some investments and generating some capital gain. And then also there's what's called the net investment income tax. This is an extra 3.8% tax that was created with the Affordable Care Act. So effectively, yeah, your investment capital gain tax rates could be as high as 23.8% if you're over the highest income thresholds.
Switching gears, let's talk about retirement contributions. So the 401k and 403b max employee deferral or max employee contribution increased a little bit. If you're under 50, it's 23,500. If you're over 50, you can do an additional 7,500. So that would be 31,000 total of employee dollars if you're over 50 years old. One thing that's new this year, as you'll see on these pages we're going to throw up, there is between age 60 and 63, there's an additional catch-up. So rather than 7,500, it's 11,250. So it'd be that 23,500 plus 11,250.
That's going to be fun to keep track of.
And yes, it will, but that's what we're paid to do. But another great way to put even more into your workplace retirement plan. That's a new change as of this year. The total dollars that can go into a defined contribution plan, 401k, 403b, is 70,000. So that number is a combination of all employee dollars and all employer dollars, right? So that it would include that deferral plus, say, a match plus profit sharing And then there's also um, after-tax contributions that some plans allow. But total dollars that can go into that retirement plan is 70,000 for 2025. The contribution limits for traditional and Roth IRAs did not change. So 7,000 if you're under 50, 8,000 if you're over 50. And then contributions to Roth and IRA stepped up a little bit. So you'll see these numbers here. Like for a single filer, you have to be under 150,000 of income to be able to directly contribute into a Roth. You'll see for an IRA, if you have a workplace retirement plan, that number's lower, 79,000. So you'll see also the married filing joint numbers there. But let's see, other changes you'll see on this chart. Those are the ones we want to point out in addition to required distributions. So you'll see the IRS life expectancy tables are here where you can see what the factor is for your RMD, how they calculate your RMD based on this IRS factor. Now, one change we did want to note is for inherited IRAs, which they've updated guidance for the past really 3 years. So if you inherited a retirement plan, an IRA, after 2020, they started a 10-year rule. So rather than being able to stretch those required distributions over your lifetime, they said the money's got to come out in the next 10 years. But they didn't tell you if you had to take every year, if you could wait till the end. So they've said if you haven't taken out and you're under that 10-year rule, if you haven't taken it out up to this year, you're okay. We're going to forgive that. Starting in 25, you are going to have to take a required distribution, even within that 10-year rule. Now, it's not the remaining balance divided by 10 or divided by 7, whatever it is. There's a different calculation, but we will be letting clients know you've got to take a required distribution. It's a smaller distribution, but we wouldn't want to see you penalized. So those are the main retirement numbers we wanted to point out.
I think that's even based on you are subject to that required distribution if the original account owner was already taking required distributions, which usually with a retirement account, most people fall into that because they're inheriting from a parent that's over a certain age.
Yeah. I mean, the thing with inherited IRAs is let's talk because it's gotten very nuanced with the rules. John, Social Security.
Yeah, so for 2025, they gave a 2.5% cost of living adjustment, which kind of actually glad to see that number flatten out a little bit. You know, there was that one in 2022 that was like 8.7%. That's when inflation was running really high, and I think most people would rather have not have had the inflation and not have gotten such a high increase. But the wage base, the amount of income, max income that is taxed for Social Security has risen to 176,100. I mean, that's kind of been steadily increasing. I think last year was like 168,000 or so. And so it's just, more revenue is going to be coming into Social Security as they increase that wage base. And then, yeah, keep in mind the earnings limit or your full retirement age. Your full retirement age is based upon the year that you were born, and originally it was 65, but it's getting scaled out to 67. And it's important to know that number because there's an earnings limit if you try to collect Social Security while you're still working. And so, yeah, if you're below your full retirement age, you can only earn $23,400 before they'll actually withhold some of your Social Security benefit, if not all of it. And the year that you turn full retirement age, you can actually earn a little bit more, 62,160. That really benefits people with birthdays earlier in the year as compared to November or December. Not sure how that's fair, but
luck of the draw.
That's right.
But once you reach full retirement age, you can
earn as much money as you want and collect Social Security.
That's right. Medicare. You'll see here, Medicare Part B premium has increased from $175 to $185. Income-related monthly adjustment amount. I get it?
Sounds good.
So that is, if your income is over a certain dollar amount, you have to pay that $185 plus a surcharge. Same with your prescription D plan. So These numbers increase every year. If you're single, the number is 106,000. So if your adjusted gross income, it's actually modified adjusted gross income, but think of it, if your total income's under 106, you're going to pay that 185 per month on your Part B. As it increases above that, that's where this surcharge kicks in. So we'll show you these brackets. But if your income single is over $500,000, you're going to pay 185 plus $444 a month just for Part B. For married filing joint, those surcharges start at 212,000. Now, one other note on the IRMA is we look at it with clients because we want to keep you under so that you're not paying that surcharge. And if there's if there's a life-changing event, right? So generally when you retire and you're going from high income to lower income, well, they look 2 years prior in your tax return. So, they may be thinking, okay, well, that income's going to continue. You can submit this form that says, I had this life-changing event. I project my income to be X, a lower amount. Don't charge that surcharge. And then they will process that. They won't withhold that from your Social Security benefit, or you won't pay that as part of your Part B.
They'll even give you a refund if you file that later in the year. You will get money back.
But if you underestimate, you file your taxes and they say, whoa, you were way over what you said, they're going to charge
Well,
that back when you filed.
gonna get you.
They're going to get you.
So moving on, the health savings account limits, the contributions have increased. For an individual, it's 4,300 this year. For a family, it's 8,550. And if you're 55 and older, you get an extra $1,000 as a catch-up contribution. And with that, the catch-up contribution, it's kind of specific to who's over 55. So if you find yourself in that case, like for instance, my HSA was originally done through my wife because at the time she was working and her employer would contribute to it, and we were on her health insurance. Well, if I turned 55 and I wanted to do the catch-up contribution, I'd actually have to put that $1,000 into my own HSA. So it's important to keep that in mind. But of course, with a health savings account, there are there's criteria about what health insurance plan you're on. You must be on a high deductible plan. So you can see the minimum annual deductibles and the max out-of-pocket expenses listed here. But gosh, they're great accounts. HSAs are one of our favorite accounts. They actually turn into almost a mini retirement account once you're over the age of 65. You can use the money on anything. Now, if you pull it out for something other than a qualified medical expense, you will pay income tax, but that is just like a retirement account, so a pre-tax retirement account.
Yeah.
So
It's really the only triple tax benefit type account I can think of.
yes, I mean if you're contributing to an HSA, you want to try to do it through payroll withholding as well, because you can even avoid Social Security and Medicare tax.
But even if you're self-employed, you can open an HSA. But you get the tax break on the front end. You can actually invest the dollars in most plans tax-free, and then withdrawals for medical expenses are tax-free. And the list of qualified medical expenses is
Pretty extensive.
just about anything you can think of. Finally, estate tax. So the lifetime exemption has been increasing every year. Now, it was doubled in 2017? So it jumped to a much higher level. What does that mean? That means if you're under this number, your estate's not going to pay any estate tax, which is at about 40%. So it's a high rate. If you're over that number, the amount of dollars over for 2025, 13,990,000. So let's call it 14 million. If your estate exceeds that, that's where the estate tax kicks in. Now, I'll also say that's where good estate planning comes in to try to mitigate that potential tax. Also, the annual gifting limit increases from 18 this year to 19,000 next year. So that is the amount of dollars a person can give to another person without having to report it or without it going against their lifetime limit, which is that same 14 million for gifts. So for instance, a married couple could gift to their child $38,000 next year. So you can double up that way, but that's where you can really start gifting large amounts and getting those dollars out of your estate tax-free.
Or we have one client who likes to take his kids on some pretty nice vacations, and he calls that his estate tax management.
That's
It's a
that's
good way
another
to go
way to
about
do
it too.
it. Now, one last note, and we talked about this earlier in the year. These tax rates and estate tax exemption are all set to sunset at the end of 2025. Now, we'll see if that's going to happen. Based on current administration, it could be they push those out. Wouldn't be surprised, but it would require legislation to extend these tax brackets and estate tax rules and everything. So we'll certainly stay in touch with you throughout next year. If we'll stay up to date on if those changes are coming and what needs to be done before then.
Well, thanks for watching. 2024 was a great year. We are very grateful to be able to work with you. We're always looking to get better at what we do. We welcome feedback. We're excited as we head into 2025 for another great year of investing and planning and anything else we can be doing for you. So we hope you had a great December and call us if you need anything.
Happy holidays.